What's going on, everybody? It's Brian Tripp. Welcome to another episode of the Real Estate Investing Live podcast. I am here in Birmingham, Alabama. So glad you decided to join us today. We have a very special guest that is going to talk to us today about hedge funds. Spent some time with a very prominent hedge fund group, and I haven't had anyone on our show talk about this before. So I'm very interested to speak with you. Matt, I'm going to bring you into the show. Matt, how's it going today?
Hey, good, Brian. How's it going with you?
Going very well. Got Mr. Matt Bell, and you're in Charleston. Is that right? You're in Charleston, South Carolina?
Yes, sir.
So let's just kind of start. I know you've been doing real estate for a long time. Tell everybody what is a hedge fund and what your particular role was with that particular hedge fund.
Sure. Well, it's a bit of a broad answer. There's a lot of different hedge funds and a lot of different niches that have hedge funds. Real estate has become the latest and greatest hotspot for hedge funds. Prior to, I would say probably 2012, give or take, institutional money, aka Wall Street money, was not in real estate, right? They couldn't figure out how to rate. And when I say rate, I mean like A rating, AA, AAA, B, so they rate securities. And they couldn't figure out a way to rate real estate up until about 2010, 11, 12, somewhere in there. So what happened was like a turning on a faucet or flipping a light switch. Once they figured out that they could rate real estate, now all of a sudden it was no longer Greek, right? It made sense to them. It fit. And so a tidal wave of capital has gone into the real estate world in the last decade that has changed it immensely in that amount of time, and will continue to change it going forward. I mean, when I'm talking about immense amounts of money, I'm talking about this is the kind of money that could wash out the National Association of Realtors, for instance. I frankly think agency may be, if it's around, it may be totally different in a decade. This is trillions of dollars, and it's exciting because there's an opportunity there, but it's also scary, I think, for a lot of people because it's different, it's new, and this is a different set of players, if you will.
So Matt, you just gave me a ton of stuff right there, and I want to try to break this down. I want to learn because there's a lot of things that you just got done talking about that I don't even know about. And I'm sure that there's going to be a lot of people who are listening. You're talking about rating securities. You're talking about wipe money, kind of money that's going to wipe out the NAR, the National Association of Realtors. So yeah. I want to talk about all that stuff. But first, kind of clue in some of us who may speak in real estate speak. We may know the real estate language, but we don't necessarily know the Wall Street language. Let's kind of bridge that gap for me included, for our audience. You're talking about rating securities. What is a security? What's a rating system? What is all that?
Yeah. So again, I'm not a finance guru by any means, and I certainly haven't spent any time on Wall Street personally. I've just worked closely with some guys that were from that world and picked up on some of the vernacular over the years working with them. So securities have different ratings, and that has to do with how much they are valued at, as well as insurance. And essentially, when they figured out, hey, this is the higher the rating, a AAA, for instance, is the highest rating you can have. That's the highest valuation that you'll get. It's what they view. It's basically a safety rating, if that makes sense. So they figured out that so in our world, in the investing world, if we're talking about a single family house, for instance, an A asset would be something that's maybe new construction, recently renovated and newer. A B asset may be something that's maybe built in the 90s, that is, I don't know, 100K to 200K, something like that. So like your safest assets from their perspective are the 250 plus houses that are brand new, right? That's the most stable asset that they'll see, all the way down to $50,000 houses that are train wrecks that need a ton of work. That would be like a C minus, or maybe even, I don't even know if there's a D rating, but something like that, right? It'd be way down the list. So there's a spectrum of ratings. And so when you get to the huge money investors, like institutional level money, state pension money, for instance, the first, so it kind of flip flops, right? For all of us little guys, it's all about return on investment, right? And then, and we'll take risks for that reward. So risk and reward are kind of in a certain order, and they flip flop when you get to an institutional investor. The first goal for somebody who has billions of dollars, the first rule is do not lose the money, right? That's the first thing in order of importance. Behind that is, and yeah, let's try to make some money as well, right? That's why they're willing to buy an A asset, right, versus a C asset, where the cash flow may be much better, right, on that C asset, but it's not viewed as safe as an A asset, right? So if the market crashes or does something crazy, well, now they have something that they can resell from their perspective much easier, if that makes sense. So it's really, it's almost an inverse perspective to how I approached and most of us approach investing.
Yeah. So you start talking about, you mentioned pension money, which is what's getting invested. And the most important thing is we don't want to lose the actual investment itself.
That's right.
And, if that means we're only making a 1, 2, 3% return, so be it. We don't want to lose the initial investment. And then, and then you went along the rating scale, which I think is very important, obviously applicable to us. And, we see things like you said, more in terms of ROI. We want the best bang for our buck that we can find. So let's tie that back into a hedge fund that's going after some of these properties. What is, you mentioned in the very beginning that you said that they didn't really know how to rate real estate. And I guess now they've kind of figured that out a little bit. What is kind of the general sense as far as that goes today?
Yeah, they have. There's you're starting to see securitization of debt in a big way with single family residential. It's been around in multifamily for years and years, right? Everybody in the multifamily world refers to assets as an A class asset, a B asset, right? But it didn't necessarily ever translate in the SFR world. So now that it does, now that they've kind of cracked the code on what it looks like, there's just tons and tons of money flooding in from non-traditional places.
So let's talk about that. Let's talk about like what does that even mean? Money that's flooding in from non-traditional places. Like, what does that mean?
Yeah, so I mean, there's trillions of dollars on the exchanges in Wall Street, right? Mm-hmm. And none of those dollars, or very few of those dollars, were ever invested in anything other than, say, a REIT, right? Like a real estate investment trust, something that was specifically designed for Wall Street to buy, sell, and trade. They couldn't figure out how to do it So they figured out how to do it in a vehicle that made sense to them, just like a stock or a bond or anything else, right? Which is what a REIT is. Mm-hmm. Is similar in that it gives them a vehicle, much like a mutual fund or anything else, to sink money into real estate, but it's not really actually buying a house. It's buying a percentage of a pool of assets where they've got some diversification of debt. Some of their what they would consider exposure is mitigated over a pool of assets.
So that leads me to the natural question: what's the difference between a REIT, which is a real estate investment trust, and a hedge fund? What's the difference?
Right. Well, so they're both pools of capital. They both have their own investors. They have their own capital. They have their own assets. A REIT is something that is federally regulated. So there's government oversight when it comes to a real estate investment trust. It's been registered with the Securities and Exchange Commission, and it is watched. And there are reporting requirements, management requirements, return requirements for the investors as well. That none of which is the case with a traditional fund. A traditional fund does not necessarily have mandates with any of those pieces. It's much more of a, hey, can you sell it type thing, right? It's not regulated. It's just, hey, can you make this attractive enough for an investor to invest with you? It may, for instance, I think all but, I don't want to misspeak here, but I believe that all but 1% every year of a real estate investment trust has to go back to the investors. I think that's right, and that's on the net side. I'll have to double check that. But anyway, the point of the difference is one's federally regulated and has mandates, and the other is not. It's basically just you're building your business however you want to build it, and can you make it attractive or not for an investor.
So, and that's the hedge fund piece. Is a hedge fund? It's not publicly traded? REITs
don't have to be. Some of them are. So some of them have an IPO, initial public offering, and then they go public, and then they're publicly traded. Most of them, the guys that I worked for, were private capital. They were private.
Which means what? Is that what a private equity fund is? So,
exactly.
So the group that you work for was not, I guess, technically a hedge fund. It was more of a private equity fund. Is that?
Yeah, it's essential. I mean, I use those interchangeably.
Gotcha.
They're a hedge fund basically comes from hedging risk, right? And so private equity is where most hedge funds start, and then the ways that they invest hedge against risk and bring in whatever that return is. So in our case, everything in the initial capital raise is private equity. I say our case, the fund that I worked for's case. Everything initially is raised as private equity. And then, I'm going to do the math with you here in a second, just to kind of come full circle and make it make sense. But basically they do a raise, then they take out leverage, which mitigates. Now you're starting to use other people's money, your bank money, which helps with your exposure. And then they will deploy that capital as well, and then they'll use even more bank capital. So they had a 1.5 debt ratio, and what that means is, and again, I'll just give you broad numbers. So they raised $70 million. Okay, they buy $50 million worth of properties, right, assets. Then they renovate those properties for the remaining 20. So they've deployed $70 million. Okay, then they send the BPO person, right, the appraisers around, and the appraisers come back and say, the houses that you bought and renovated are now worth $100 million. So we're going to give you 70% LTV. So they get $70 million more dollars, right? They deploy that $70 million and then do the whole thing again. So basically, the long and short of it is they're buying 3 houses, one of which is with private equity, and the other 2 are with debt capital. So that's where the 1.5 debt ratio comes from.
Who's lending? This is kind of a sidebar. Who's lending that?
Yeah, there's a lot of institutional lenders now. Again, now that everybody can make sense of it, and with ratings, et cetera. B2R was a big one. That was the Blackstone, I think. Mm-hmm. The group that has Invitation Homes, they have a lending arm. Invitation Homes is the largest fund out there. I think they have something like, I don't even know how many, 60,000 homes, I think, something like that. Huge. They had a lending arm, and they were doing some lending to some other smaller institutional players. So B2R is one, CoreVest is another. There's a handful of others.
Yeah, it's just interesting that you're talking about that. I mean, that's big. You start getting into
huge money,
big money. Yeah,
huge money. It's 70 million is not. That's not, as a tranche. It's not that much.
Yeah. So let's bring this back kind of full circle, and let's tie this into some of these areas that, especially an area where I live, where you live. You're in Charleston, South Carolina. Yeah. Columbia, South Carolina is right there. You've got places like Birmingham, Huntsville, Montgomery, Alabama, Jackson, Mississippi. You've got kind of Charlotte. You got the Kansas Cities out there. There's so many markets that I hear and see a lot of these funds that are going into just because the numbers work, the cash flowing numbers work. Talk about that, and I kind of want you to talk more about like broader than maybe just the company that you happen to work for, but just in a broad sense. When you start talking about these funds, wherever they are, why are they going into places like Charleston and Birmingham and Louisville and Charlotte and Kansas City? What makes those places so attractive and not LA and Chicago and New York?
Yeah, so the primary markets, the bang for the buck isn't there. I mean, Charleston, for instance, is a destination city. It's very expensive to live. So if you were to buy and try to hold, your rent return is just not very good. Although you're in maybe an A asset, that there's a trade-off, right? There's an inverse relationship, generally speaking, between equity play and cash-on-cash return. So they love those secondary and tertiary markets because the cash-on-cash return is much stronger, where the median home prices are maybe a little bit lower. The sweet spot for the group that I work for, and frankly, the majority of them, is probably in that, I don't know, 70 to 150 range, 70 to 150K purchase price or all-in price per the rent. You hit a point of diminishing returns right around 125K per the rent. So let me just, I don't want to get too sidebarred off of that, but I do want to talk a little bit about the evolution of every fund, because they're very, very similar. And since you wanted me to kind of touch on something globally, they all start with cash on cash, almost exclusive focus. So they end up starting with C assets and, having a really high, 12, 14, 18% return. Like the guys I worked for, when they first started in 2012 or late 2011, they were getting really, really strong returns, right? Well, that's your first series or your first fund. It's also called the proof of concept series. So they'll go out and they're going to prove that they can do this with like 100 homes, let's just say. And a lot of the times it starts with friends and family money. And then once they have what they would consider a proof of concept, then they go out and now they can sell it. Now they can pitch it, right? And try to find real capital from, say, the Wall Street area. So the guys that I did, the first tranche of homes, the proof of concept series was 100 homes. The second one was they went to 1,250 homes, which was raised elsewhere. And then the third, I think, was a private. Fourth was like 3,000. Anyway, they graduate up and up and up and up, and more capital. And there's this, you kind of have to graduate to each level. And what I mean by that is state pension money is as big a money, and we're talking billions and billions and billions of dollars. They don't even return your phone call until you have the ability to move the needle for them. So you have to get to that, right? Just like securitizing debt, like they don't want to talk to you unless you have $300 million to securitize. Like you're not even on the radar. So when you see Invitation Homes and American Homes for Rent and some of the other big Waypoint, Starwood Waypoint, and anyway, there's a handful of the big dogs, right? All they buy now is Class A assets. They're buying $250,000 houses in every market that they're in, and they don't care as much about that return because they've graduated to the type of investor that doesn't care about the return as much either, right? Again, going full circle back to the beginning, first thing is to make sure you don't lose the money. When you get to that tier, it just changes. So.
And is this, Matt, is this why you started talking about that this is the kind of stuff that could wipe out the National Association of Realtors, and this is the kind of stuff that could really start completely changing the real estate landscape when you have that kind of money buying these kind of properties? And I don't want to say they don't care about returns, but returns are so much less important than just the quality of the asset.
Yeah, absolutely. And, obviously that was a little bit of hyperbole, washing out the NAR. I do think it'll be very different though. And I feel like if people don't recognize that it's coming, like buckle up, because it's here. The money is here now in this space, and it will change completely. Zillow is already flipping homes, right? If you don't think Zillow is going to buy and sell and transact real estate online and completely cut out real estate agents, I think it's naive. I think that's going to happen if it's not already happening. And then you have all the iBuyers, right? You got OfferPad and Red Door and Roofstock and all kinds of different iBuyers that are entering into the space too. That's all because of Wall Street money. So yeah. I don't, and then you throw in the virtual stuff that's going on, man. Like, I think that, and again, this is just my gut kind of 2 cents usually, which is worth about a penny. But I think that people are going to be walking homes virtually in a decade. They're going to put their VR on and they're going to walk around a house and they're going to buy, sell online without ever going into the house. Maybe doing a drive-by or getting a feel for the neighborhood. But like, I think this is just my 2 cents, but I think the high-end homes, the $1 million home stuff, like people want their hand held, right? Like that's a personalized experience type thing. I don't think that gets washed out as easily, but I do think on the investor side of the world, rentals, flips, like we're going to be looking through homes, like sitting in our office on VR. I fully believe that. So, and it's because of these guys. They're playing with money that, to your point, they don't care a ton about return, right? And that's why it's hard, and that's why everybody's afraid, because they can outpay, right? They're gonna overpay for what you or I could pay for it. But I feel like that's short-sighted, because there is a huge opportunity to work with them.
Yeah, so that's what I want to get at. I want to tie this into the wholesaler that's out there, the rehabber that's out there. Let's start talking about just average, ordinary wholesaler, maybe doing a few deals, maybe doing 20, 30, 50 deals. How does this affect a wholesaler? How do these funds and all this money, how is this going to affect a wholesaler? You just got done talking about we can work with them.
Yep.
I think there are two different ways we can see this. We can compete, which I don't think we can compete.
Nope.
Or we can choose to work with them. How can we work with them?
Yeah, I think so. And I mentioned earlier, I was terrified that some of these guys are going to IMN now, some of these SFR guys. If we teach them how to source off market, they will step on your neck. They're going to take everything you got and do it themselves the second they understand it. So what I would say is sell them houses, do what we do best, find deals off market as much as possible, and sell them assets. They're going to buy it. Frankly, they're going to overpay for it. We already know that because they can pay more than anybody else. So if we can be experts as individual investors at sourcing deals, which a lot of us are good at, that's the play for me. I mean, it's either take it down and list it and let them gobble it up after you've listed it, or take it down and assign it to them, whatever. I think they'll buy it if it's a decent house, and depending on where the fund is in the life cycle, like we were talking about, you know, Invitation, they're not looking for C assets anymore. AH4R, they're not looking for C assets anymore. So you got to know who you're talking to. But that's the opportunity.
Yeah, for sure. So Matt, you spent some time, a significant amount of time working for one of these really big funds. I want you to talk about how the wholesaler can work with them, maybe finding them off-market deals. One of the questions I get asked often is, how would someone find who is the actual buyer? Who is the actual point person in my local market? How do I even find these hedge funds? How do I find the actual person to talk to?
Sure. Yeah. It's easier said than done in most cases. Generally speaking, most of the analytics go on in-house wherever they're based, the fund. But in most cases, I don't want to say all, but in a lot of cases, the guys that I work for instance, they were working with an agent or a couple of agents in the market that basically was doing all of the writing of the offering and the negotiation of the contracts, et cetera. So if you can find them, I don't necessarily have I tell you how you can do it, frankly, is get on the tax assessor site and figure out, what the name of the, big buyers are. You can definitely find that. And then if you can utilize your MLS, or if you have an agent that is nearby that can plug in, they can figure out which agent is working with which buyers for sure.
Yeah.
So that's the best way to go, straight line. But globally, Brian, I would say take it down and list it. They'll find you. In that case, they'll find you, right? Because they will gobble it up if it's on the MLS. That's how most of them buy.
So I want to recap this because Matt just provided us some golden nuggets right here. This is huge. These were two huge points that Matt just made, and I love this stuff. The first way he said to find these hedge funds is, first of all, find out the name of the fund, find out who it was just by looking at the tax records. You can go and sort properties by who bought where the most cash transactions. You can sort it by that and find who is buying the most. And some of these bigger funds, they're going to be at the top of that list. And so what we're going to do now is we're going to find those properties, go to the MLS and see who the listing agent was or see who the buyer's agent was, and contact that agent and that agency, that brokerage, just directly. So that's one nugget. That's huge. And then this, I've been saying this for years. This is how we discovered it in like 2013 and 14 and 15. This is how we discovered all these new funds that were coming about. We discovered them by just taking down a property every once in a while. Just go and buy it. Even if you're a wholesaler, find the private money, go ahead and buy it and relist it as is. Maybe clean it up a little bit. You don't have to rehab it. Maybe sweep it out and clean it up. Clean it out if you feel like you have to. Or you can just turn right around and list it as is. Matt just said this. They will find you. Guys, it's unbelievable. I remember the first time this happened to me, house here in Birmingham, where we went ahead and took this thing down. We listed on the MLS, and we were thinking we'd probably get about, we're here in Birmingham, so we got a little bit lower price points, and we were thinking we'd probably get 50, 55 for this thing. We bought it for like 40, 45. We got an offer. We put it out there really high. We got an offer above asking from a big hedge fund for like $74,000. We ended up making one of the biggest wholesale spreads, and this is like 2014, that I had ever made. And it's all because we went and took it down and just listed it. If you can do this, this is how you're going to find these hedge funds. You're not going to find them. They're going to find you, and once you've proven that you're good and easy to work with, they're going to want to keep working with you. Like Matt said, work with them and find them those off-market deals.
There's a way to make money with any place in the market cycle, with any buyer and seller. You just have to figure out where it fits. Those guys they're always going to pay more than we will, and so trying to compete heads up with them is just it's a losing proposition. But there is a heck of an opportunity to sell them properties and make a lot of money.
No doubt about it. No doubt. Matt, I can't thank you enough for giving us some really great perspective on just funds in general, hedge funds, private equity funds, and REITs. And it's just really interesting to learn this stuff and bring it back home. So maybe the wholesaler who's listening to this, maybe even the rehabber, people who are listening to this that are in the trenches every day, how this can actually apply to them in their city. And Matt, before we go though, I want to give you an opportunity to talk about some stuff. I know you've kind of moved on from the hedge fund world a little bit. Mm-hmm. Talk about what you're up to today and how you could potentially provide value to our audience.
Yeah. So, to harken back to the Rich Dad, Poor Dad days, which is how I started this entire, journey. You talk about the 4 quadrants, and quadrant 4 is kind of when your money is making money. I have an operating business. We do well. I generally have consulted outside of that business. I consulted for the hedge fund for years as the director of renovation. And now I'm consulting for a large lender, institutional lender based out of California. It's a fix and flip lender primarily. We should have a rental portfolio product out here in the next couple of months. But anyway, they've hired me to build a national sales division for them. And the company's name is Lending Home. And so I started with them a couple of months ago, and I'm working towards the lending side of the world. I feel like it's the next iteration is becoming fluent in private capital. So starting to cut my teeth, if you will, there, and learn a new vernacular, and yeah, so we've got a lot of opportunity to help people on the funding side. And, I just generally like to help people anyway. So whether it's connecting people or talking about scaling businesses or renovation or whatever, love to be a resource.
That's awesome, Matt. How can people learn more, and how can they reach out to you? Do you have some contact information?
Sure. Yeah. Well, I mean, you're certainly welcome to my email. It's matt.bell@lendinghome.com. And always welcome to field questions, whether you're on your first deal or your 100th. We have products for everybody, and you're welcome to reach out to me directly on my phone. I'm fine with that too. I'm always available at 706-267-3293. Love to help.
Guys, we're going to link all that up in the show notes. So don't feel like you got to break your neck to try to write down a phone number. It's going to be right there in the show notes for you. We're going to link all that up, put Matt's phone number. You're very brave, Matt, for giving your phone number out and his email address. So you guys can go check that out if you have any lending or if you need capital. He just said he does fix and flip loans. And they've got rental products that are coming out very, very soon. So, Matt, thank you so much. Really do appreciate you for coming on the show and giving us some great perspective on hedge funds.
Yeah, thank you, Brian. I appreciate it. Enjoyed it.
Awesome, guys. I appreciate you listening. If you like what you heard, please hit that subscribe button. Also, I think especially for our YouTube audience, you can see in the background, I've got my book right here. I wrote a book. It came out a little less than a year ago. It's called Nothing's for Sale. It is like dirt cheap. It's on Amazon for like $8. Go check it out. Just go search. You can search my name, Brian Tripp, on Amazon. You can get my book. It'd mean a lot to me if you guys got that, especially for those of you who've been listening to me for a very long time. We've been doing this podcast for about 2.5 years. So we're so thankful for you guys who've just tuned in religiously and listened to our podcast every time. So if you've not gotten a copy of my book, make sure you go get it. I've got a new book I'm writing right now. It's going to come out the beginning of next year. There's only a few hundred copies left on Amazon, and I'm not printing any more of this book. So make sure you go get a copy of that. It's like $7.99 on Amazon. So check that out. We love you so much. Please don't forget to hit the subscribe button, and we will see you next week.